They say change happens 1% at a time. So, what can you do to be 1% better today? You could take the stairs instead of the elevator. You could give a compliment instead of a complaint. Or you could change someone's life. 1% may not sound like much, but for young people in need, 1% can make all the difference. At Future Generation, we invest in a different kind of potential. We're the first listed investment companies in Australia that deliver both investment and social returns. Future Generation provides shareholders with exposure to the best Australian and global fund managers. Their job? Delivering a stream of fully franked dividends and capital growth to investors. Our boutique fund managers also have big hearts. By not charging management or performance fees, we can donate 1% of company assets every year towards changing lives instead. As a shareholder, you can decide which of our preferred charities will receive your donation, whether it's helping children at risk or supporting youth mental health. Our carefully selected charities ensure your contribution is used in the best possible way. And as our assets grow bigger and bigger each year, so does the 1% donation. This gives our charities the financial security to think and plan long term. By 2044, we aim to have donated $100 million. And the good news is, we're already on the way there, having donated $21.1 million to date. With your support, 1% can make big things happen. To learn more about how you can improve the lives of our future generations, visit futuregeninvest.com.au.
Hi everyone, and welcome to our fourth Future Generation Investment Forum and the second one in Melbourne. I want to particularly thank our board and committee members who are here this afternoon. Sarah Morgan, who's a board member of FGG, and David Leeton, who's a board member of FGX in particular. Our Future Generation fund managers, our shareholders and WAM shareholders who are here as well, Future Generation charities who are represented, stockbrokers, planners, our service providers, and others who are joining us this afternoon. I'm Louise Walsh, the CEO of the Future Generation companies, FGX and FGG. This is one of the biggest events that we do for Future Generation. We've got over 700 registrations, and we've got 5,000 people who are watching this live on a stream thanks to our pro bono service provider, Livewire. Please, we'd encourage social media. The hashtag is Future Generation Investment Forum, and we particularly like Donald Trump's tweets and Twitter, so please use that. So what's in store for this afternoon? So what you're going to hear is 5-minute presentations from 8 of our best performing fund managers with their best stock pick or investment idea. It's a bit like speed dating with fund managers, but it's not one-on-one. It'll be strictly 5 minutes each, and they will get a warning. There's a timer up here on the stage, and it'll count down, and they'll certainly get a warning when there's 30 seconds to go, and they'll certainly know when time's up because it'll start flashing. So each fund manager will have one slide each, and there's one fund manager that's going to present 2 stock picks, so he'll have 2 slides, but still only in 5 minutes. Now, each of you should have programs, and there's notes and stock picks there, so you can write notes as we go along. We're not actually giving you copies of the slides, so please take any photographs of the slides if you actually particularly need those. There's no questions and answers from the audience, I'm afraid. There's just not enough time for that, but you can certainly contact a particular fund manager on the back of this afternoon's presentation, or grab them after the event's finished today. As a special addition this afternoon to those 8 fund managers presenting their stock picks, we've included a panel session with 3 fund manager experts that's chaired by James Thompson from the Australian Financial Review. I'd now like to call on the founder and director of FGX and FGG, Jeff Wilson, to say a few words of welcome and to present a summary of the stock pick results from the first investment forum here in Melbourne in November last year. Thanks, Jeff.
Look, Thanks very much. Thanks very much, Louise, and welcome everyone. Look, thank you. Oh, I need the clicker, don't I? So let's see how everyone performed. Now we're looking at the period since we did our last forum, and the various fund managers presented their stocks. And just to give you a bit of context, since we did that, the market's down 5.4%. So that's, everyone's swimming a little bit against the tide. And let's just see how everyone went. Welcome. There we go. So, they're the numbers. So the VGI, and anyone who was here, how good was it when the boys were giving out those cans of WD-40? And to me, if my dad was here, he would have just bought the stock because he got something for free. And being a Melburnian, if he was around, he would have loved to have done that. And the various other managers, like a combination of the global guys and also the domestic guys. Matthew Kidman came in second at Centennial. Magellan Morphic. Well, you'll be hearing from Magellan and Morphic again today. So we're giving you a double bang there. Matthew must have done 2 stocks because he's there twice. So it's good to have a little bit each way. So look, thank you very much for everyone who's supported both these organisations, being FGX and FGG, in terms of what the impact we're having on the community we operate in. It is significant, and the areas we're focused on, is children at risk and youth mental health. And from my perspective, is if we effectively just save one life, like what we've done here is incredibly significant. The fact that next year we'll probably be giving about $10 million to those 2 areas, again, is significant. And it wouldn't be possible if it wasn't for you, our shareholders. The reason we're here is because of you. And I can't but thank the fund managers. To me, the fact that they're doing all this and not charging their normal management fee or performance fees, and also getting up in front of you today and putting their sort of neck on the line in terms of picking a stock, I can't thank them enough. And effectively, it wouldn't be possible if they didn't allow this to happen. So, on behalf of all the boards, all the investment committees, and I suppose all the shareholders, I'd particularly like to thank you guys, or every fund manager that's involved. In terms of my stock pick, I normally give it to you at the start, but I'm just going to keep it for a little later. So just so everyone has to stay here. Thank you very much. And now I'll pass you back to Louise.
Thanks, Jeff. Thank you. And look, before we get into the stock picks, I want to introduce the wonderful Vicky Condon. And if those of you that were here just earlier, she's the founder and the CEO of Raise Foundation, one of our FGX charities. And we wanted to give you a taste of really the charitable investments, where that 1% is going. And to date, we've actually donated $21.1 million, which you actually heard on that video. Raise Foundation is one of the 22 recipient charities that we actually support. And next year, the combined donations that'll be going from FGX and FGG will be over $10 million. We anticipate that within 10 years, that donation will be $30 million a year. So it'll be absolutely essential. Now, for each presenter today, I've asked them if they could give me a quirky fact or 2 about themselves, because the bios are actually in the program, so I don't want to bore you by reading all of that out every time someone walks on stage. But this is Vicky's, and it wasn't Vicky, I think it might have been her husband who provided it. So for a seemingly classy chick, Vicky is actually happiest in her Uggies, watching the footy, eating hot chips and gravy. Now, aren't we all? So please welcome Vicky to the stage.
Thank you, Louise. I can't believe you stalked my husband for that fact. It's actually very true. I am a footy chick from way back, being an Adelaide girl originally. I'm very grateful to be here. Thank you very much to the Future Generation Investment Companies for giving me this opportunity, and I know that you're really here for the stock pick, so I will not take very long. I know you want the sneak information. I wanted to start by asking you a question. What do you think is the biggest killer of young people in our country? I can hear a lot of the whispers. It's suicide. People die by suicide than by any other cause. They're killing themselves. And at Raise Foundation, we just think that is not okay. So the work that we're doing is an early intervention strategy trying to make sure that we can impact that and change that statistic around. We're really concerned about young people at Raise. The future of our young people is looking pretty bleak for many of our young people. So we know that 1 in 10 young people are completely disengaged from education, employment and training. That the poor mental health outcomes result in social isolation and lost earnings for our country of over $11 billion in GDP. This is a massive, urgent issue that we need to work on. I know that I've started with all the bad news, so the good news is at Raise Foundation, we run best practice mentoring programs as an early intervention strategy to help change those outcomes for young Australians. We know that a young person who has a mentor is more likely to finish school, find employment, be happier, have higher well-being. We know that having a positive, neutral role model that is not necessarily a teacher or a counsellor or a parent can make all the difference in changing that one life or saving that one life, like Jeff was talking about. So our vision at Raise is about creating thriving communities. Our communities benefit from Raise because we're training up mentors. As much as impacting the young people's lives, we're training up mentors on how to speak to and listen to properly the young people in their lives, either at work or in their families or in their communities. And we're doing that through this best practice mentoring, and our big objective is about empowering young people to become more resilient and more capable and more connected. So that's the work that we do at Raise. We have a few key differentiators. We provide best practice training for all of our volunteer mentors. Not all mentoring organisations do that, but we have 12 hours of best practice training, and that's all free for our volunteers. Our programs are all run by qualified counsellors as well, so you're not just matched up with a young person and then you have to go and sit and sort of work out, okay, what will I do now, and be on your own. You're in a secure environment with one of our qualified counsellors in a group of 15 mentors who go into a high school every week for an hour to talk to and listen to a young person consistently for all of term 2 and all of term 3. And that's the commitment. So we have these qualified counsellors. We also do comprehensive evaluation. Our evaluation is really important because we need to be able to prove the impact we're having, but also improve that impact year on year, so that you know that the donated dollar goes a long way in our organisation. The measures that we have, this is what you can see, the difference that we're making with our young people in our programs. We're helping them to build resilience and increase their relationship skills. We're teaching them how to ask trusted adults for help and find trusted adults around them that they can go to for help. We're helping them to increase confidence and coping skills, how to set and achieve SMART goals for themselves, and also how to engage with education and employability skills to help them to find work and build their happiness. So that's what we can do. We are very fortunate to be part of the FGX family. It was actually extraordinary the day, it felt like Christmas, the day that Jeff rang and said, told us that we had been selected. It goes such a long way and makes such a big difference. This year alone, we received a donation of $198,000, which is just extraordinary, and that meant that directly 99 more young people could go into our programs and have a neutral positive role model to talk to for that whole year, and also meant that we could take 7 schools off of our wait list. The other people who are helping our organisation alongside FGX is our patron and our Patrons Advisory Council, which is chaired by David Gonski. We only had to stalk him for a little while to get him to say yes to be our patron. But he's been remarkable, and along with our Patrons Council there, people like Shamara have helped us to develop a really big, hairy, audacious goal of taking our program into every single high school in the country. Now, we can't do that without support from organisations like FGX and people just like you. All we really need to be able to make that really big difference for young people in our country is your time, your treasure and your talent. FGX is taking care of some of the treasure for us, which we're really grateful for. There are lots of talents that you can share, but also if you have the time, please do go to raise.org.au and sign up as a mentor, because we really need your help, and most importantly, young Australians need your help. So thank you.
Thank you, Vicky. That was fabulous, and just gives you a taste of where those dollars are actually going. So, lastly from me this afternoon, here's, instead of you getting a disclaimer from a bunch of fund managers, we thought we'd just put this one up because who knows, you don't want to hear 11 different ones. So now we'd like to get on with the show, and I'd like to introduce our first presenter, who is Rosie Malcolm, who is the head of franchises at Magellan, one of our FGG fund managers. And a quirky fact about Rosie is that she enjoys, in fact she loves Lego, from the small sets to the unbelievable 4,000 piece kind. So welcome, Rosie.
Thank you so much. Thank you, Louise. So if you feel like you missed it last year, we don't think that's the case. I wanted to talk to you today about Starbucks. So let me just level set around what Starbucks is and then talk you through why we like it. Starbucks is the largest coffee company in the world. They have about 29,000 stores across 29 countries. They have 95 million transactions a week and a market cap of about $90 billion. There are three main divisions. The first one is the US business. It's about 15,000 stores. They've got 3,500 stores in China, and they also have a channel development group. What I mean by that is that's their consumer products group. So it's coffee pods, coffee beans, that sort of thing. So why do we like it? There's three main reasons. Firstly, the strong brand. Secondly, we see this asset as defensive. And thirdly, because we think it has a multifaceted growth profile. So to start with a strong brand, Starbucks has done a great job of building a very personalized product and doing it consistently and en masse, which sounds kind of counterintuitive, but what they've done is created your own special coffee. You can get that at any store you go into, and that really connects with customers. It has a very loyal following, and I think a key part of that following is also that their customers have become very acclimatized to that Starbucks taste. That keeps them coming in, it keeps the revenue and the earnings stable. The other reason we like it is that we see it as a defensive asset. So if you think about coffee, it's a bit habitual. Another way of saying that is that it's addictive, which means that you keep getting the revenue, you keep getting people coming through and buying more. And we think it's defensive in another angle, which is if you look at the retail space and what's happening at the moment, there's a lot of disruption through the internet. We don't see that for Starbucks because it is a destination, it's a place that you go. You cannot send Amazon to drink your coffee. The other reason that we like it is the multifaceted growth. Let me talk through each of the divisions in terms of what it offers. You've got the US business. The US business, it's about 70% of the company, so it's definitely the more mature angle, but they do continue to have store growth opportunities. They also have people now coming in buying food, attaching that to the beverage purchase, in addition to beverage innovation, so nitro brew, cold brew, refresher drinks. All of that is bringing new customers to the store and continuing the excitement that they have for the existing customers. They have a very strong membership rewards program. However, there has been a hurdle historically, which is that you had to preload your card. They've got rid of that, brings in more people, members shop more, they spend more, they visit more. but they also want to connect with the non-members. So they've had a program over the last 6 months of signing up people, whether it's through the app, it's through email. They've collected 10 million additional potential customers over 6 months, which is really impressive. And getting those less frequent customers to come in more by personalised marketing, specific offers direct to their email address, that's a growth opportunity over the next few years. Let's move on to China. The China business has 3 different areas of growth. Firstly, the Chinese middle class is expected to double over the next 4 years. If you think about the Chinese consumer, the average Chinese drinks less than 1 cup of coffee every year. You think about that in terms of the US, the average US consumer drinks 300 cups of coffee a year, so roughly 1 a day. So there's a real opportunity there to get that consumption up. The other thing about China, if you look at the US population, you've got a population, there's about 20,000 people per store. In China, there's per Starbucks store. In China, there's 500,000 people for every store. Even if you just take just the middle class, it's 100,000 people per store. So there's a real growth opportunity in China, both in the number of stores, people becoming wealthier and buying Starbucks, and also drinking more coffee. Then we look at the Channel Development Group. Starbucks has always been strong in the US in selling coffee beans and coffee pods, but not internationally. They recently signed an alliance with Nestle. Nestle is number 1 market share across all coffee products. They've got about 25% market share. They've got a great distribution system. They're in 190 countries, and they've signed up so that Starbucks can sell their products through Nestle's distribution system around the world, which we think is another really great opportunity. But it's not just about the revenue growth, it's also about the cost-cutting program and about their commitment to return capital to shareholders. They're going to return $25 billion over 3 years. We're 1 year into that program, they've got about $16 billion left. That's about 20% of the market cap coming back to you as shareholders over 2 years. So when you put all of that together, we see a company that can grow their net income 7 to 10%, add onto that some buybacks, that's about 3%, add onto that some dividend yield, about 3%. So you get a total return, we think, of around that 15%, mid-teens type level. You get that return for a 24 times price to earnings multiple, and in the context of the strength and the longevity of what we see that growth, which could in fact be multi-decade, in addition to a very strong brand and a very defensive product, that's why we like Starbucks. Thank you.
Thanks, Rosie. And it is quite amazing, those stats about China, I have to say. Now, the quirky fact about our next presenter is that he loves to play board games. In fact, his wife recently banned him from buying any more because his collection is standing at more than 100. But he tells me that if you're spending time with your family this Christmas, there are 3 games that you need to buy. Ticket to Ride, Zoo Loretto, and Bang the Dice Game. So you heard it here first. So please welcome Blake Hendricks from Firetrail.
Thanks, Louise. And that is true, guys. Ticket to Ride, Zoo Loretto, and Bang the Dice Game. If you're sick of your kids getting on mobile phones and doing all that kind of stuff, it's an absolute special for Christmas. When you drill an oil well, the clock starts ticking. Now let me show you something. Imagine this is an oil and gas reservoir below the surface. If we go and drill a hole in that to extract oil, the clock starts ticking because oil is driven by pressure, and over time, as you let the oil out, the pressure goes away. What that means globally is that if you drill a well, production, if you do nothing to it, will decline at 5 to 7% per annum. The oil and gas industry needs to invest over time, and the biggest beneficiary of this is Worley Parsons, which is an Australian listed company. There are 3 reasons why I really like Worley Parsons. The first is for the position we are in the cycle. The second is for the self-help that's gone on over the last few years. And then finally, the valuation, which is just 12 times PE at the moment. The first reason to look at Worley Parsons is for where we are in the cycle. Now, if you remember, oil was over $110 in 2014. It fell all the way down to $28 in 2016. And imagine if you were running an oil and gas company at the time. The first thing you do is you cut your dividends, you fix your balance sheet, and you sure as hell do not invest another dollar until you get things going right again. The oil price has been recovering over time, and it has been noisy, and at the moment we're in a little bit of a down cycle, but it's gone from $28 to today around $60. Now, what's that meant for Worley Parsons? Worley Parsons is an engineering firm, so they rent out their engineers on a dollars per hour basis. They don't do these big fixed cost projects that are blowing up at the moment. It's a really simple business. Have a look at where Worley Parsons is in terms of revenue. Gee, this is a big chart, isn't it? You sort of need to step back for a moment. But basically, in the past few years, their revenues are down 50%. The oil and gas cycle is turning, and we know this because in the past 5 months, so the 5 months to today roughly, Worley Parsons have won more business than at any time since 2013. So the cycle is returning as the oil price is returning as well. And when you consider the average oil well declines at 5 to 7% per annum, we know the market needs to spend on production just to hold it flat, let alone grow it. The second reason for Worley Parsons is for self-help. Now, we love buying businesses that survive a crisis. Emphasis on survive, because you've got to get through it. But when you do, you typically come out with a business that is run much leaner. It's got great corporate memory and typically a really fixed balance sheet. And Worley Parsons ticked all those boxes. In 2015, they actually received a gift. And the gift was a CFO named Tom Honan. Now, Tom Honan was the CFO of Computershare and Transurban, very, very experienced operator. He came in and he cut costs. He got rid of bloated head office costs. He fixed the balance sheet by focusing on cost collection. Now, you wouldn't believe this, but engineers love solving big, complicated problems, but they don't really like getting into billing clients. And that's the part where the cash hits the balance sheet. And so he became very focused on the cash hitting the balance sheet and fixed it up. With all that cost out and the fixed balance sheet, we believe Worley Parsons is actually really well placed as this cycle improves to grow earnings much faster than their revenues. And then the third reason to buy it is because it is deeply undervalued at the moment. In fact, it's trading on 12 times FY19 price to earnings ratio. There's two reasons it's undervalued, because there's no stock that trades that cheaply without a rub. And here's the rub for you. I don't think it's a big deal. The first one is they've just acquired a large competitor called Jacobs Engineering, which is a chemicals business in the US. So it actually doubles the size of the business. But because the CFO has been so conservative, he decided to raise close to $3.5 billion of equity. What that's meant is that stock has hit the market in the past 2 months, and the stock price has fallen as a result. So we think that's more technical, and we actually think that transaction will be terrific for Worley shareholders if you've got longer than a 2-month horizon. The second reason why it's undervalued is because the oil price has fallen recently. Oil hit all the way up to $85 a month and a half ago, and it's fallen quite rapidly back to $60. Worley Parsons has followed that. Some of that's fair, but I think the main point here is that you need to invest in oil and gas over time. And so if there's delays, if there's things that happen, the market will be back, it's coming back, and this lower oil price is actually the buying opportunity for Worley Parsons, and that's why it's my best idea. Thank you.
You taking your balloon?
I don't have any WD-40, but I've got a free balloon.
Thank you. Yeah, thanks very much, Blake. Fantastic. So our next presenter has 4 boys, and I think at one stage he had 4 under 4. I feel sorry for your wife, actually, Nick, I have to say. He likes fly fishing, and he used to live in Scotland, and he's now married to a Scot. So please welcome to the stage Nick Griffin, the founding partner and Chief Investment Officer of Monroe Partners. Thank you.
Afternoon. Thanks for having me. So my name's Nick Griffin. I'm the Chief Investment Officer at Monroe Partners. Monroe Partners is actually a Melbourne-based fund manager, and we're actually a global equity fund manager. And our job is to find the great global growth companies. And so we're always trying to identify big structural growth trends that are occurring in the world and the resulting winning and losing stocks. And the one I'm going to talk to you about today is one of the big structural changes that's occurring in the world. There's lots of obviously emerging players that are disrupting incumbent players. But unlike some of the ones we normally look at, like cloud computing or autonomous driving, this one's actually happening right in our backyard. And in fact, in Australia, we're at the forefront of this disruption trend. And the disruptive trend I'm going to talk to you about is the disruptive trend in the food and beverage industry. It is a big screen. And my slide's a bit messed up, but it's okay. So the food and beverage industry is going through huge structural change at the moment. So I think you'll all be aware, you only need to look around to see that people are more conscious of what they eat, partly because of the way they look, partly because they want to live longer, and partly because even when they do buy food, even if they're buying the wrong food, they premiumise that food purchase. And so from our point of view, food and beverage is one of actually only 3 categories in the world where you knowingly spend more money. The first is luxury goods. A handbag is a handbag, but people buy a $30,000 handbag. The second is athletic equipment, and the third is food and beverage. And the best example I could give you is probably A2 milk, where we all knowingly pay 40 cents more for it, yet none of us actually know what the health benefits are. From our point of view, this is a standard basket slide that we put together at Monroe, where we put together a basket of companies globally that may benefit from this structural trend. The first and foremost are the ingredients players. The ingredients players are the weapons manufacturers in the war here. They're the shovels in the mining boom. They have the ingredients, they control the natural ingredients supply chains. And I'm going to talk about one of those in a minute, which is IFF. The second and third area are the healthy natural brands or the innovative brands. And what's interesting here is you keep seeing these Australian companies come up, whether it's A2 or whether it's Bellamy's or whether it's Breville in the kitchen, because the kitchen is now the heart of the home. The fourth area is premiumisation. So this is premiumisation. It's really important to the drinks category. We see this constantly in the drinks category globally. Very few players play in it. And the last is the digital food platforms, which are obviously disrupting the way you actually get your food. And right at the bottom of the losers, these are the big incumbent losers in the world, the multinationals. And so I'm the one who's talking about 2 stocks today because I wanted 2 slides. And the first one I'm going to talk about is actually our best Australian idea. Now, we don't normally like to find Australian ideas, but as I said, we kept coming back to the ones here, and the one we found was actually just up the road here, and that's Treasury Wine. Treasury Wine is one of 2 listed wine plays in the world you can invest in. It sees strong structural growth from a premiumisation of their product and also into emerging markets. And lastly, and most importantly, it has a roll-up strategy. So it has 3 angles to grow its earnings over time. It currently trades at just 20 times forward earnings, or just over 20 times forward earnings, and you should get roughly 20% EPS growth for the next 3 years. It's actually done that for the last 3 years, and actually this stock's done quite well. But what we always like about this, and we see this all the time, most people in Australia will tell you this stock is too expensive. They might say, we want to buy Telstra, it's on 12 times earnings, this one's on 21, 20 times earnings. And we would say yes, but if you look globally, and even if you look within Australia, you might be right in the short term, but in the long run, only one of those 2 companies has a chance of doubling its earnings in the next 5 years, and that's Treasury. And if they execute and do double their earnings in the next 5 years and they hold that multiple, then the share price should double. And it's as simple as that, and it's one of the key beneficiaries on this slide. The second one I'm going to show you just very quickly is IFF. So in IFF's case, this is your much safer play, quite frankly. It is the weapons manufacturer in the war. Quite simply, what we see IFF is one of 6 major ingredients companies globally. This one's listed in the US, and it recently bought one of our other holdings, Fruitrum, in Israel. Ingredients companies basically sell into the smaller players, and they sell into the private label players. So they're a natural beneficiary of the fragmentation in the market. And even the multinationals who are trying to come up with gluten-free Cheerios need to talk to these guys. What that means is they can grow their earnings at 6 to 8%. Their revenue at 6 to 8% because they have this organic tailwind, and then they also have the roll-up opportunities. If you add some margin accretion, you get earnings growth of 15% per annum. And then lastly, most importantly, you get some multiple upside from 22 to 25 times. And again, this stock should be able to double over the next 5 years. Lastly, and most importantly, I hope you'll agree that if you believe that food is premiumising and you think this is a good structural trend, it is also an economically impervious structural trend. And so hopefully you'll agree this will be a good place to invest in the next 5 years. And these are our 2 best ideas today. Thanks for listening.
Thank you, Nick. Excellent. So our last presenter, before we have our panel session, tells me that he's been kicked out of 3 casinos in Las Vegas. Nothing illegal, he tells me, about any of it. But in fact, the song we're going to play as it comes up, I've actually chosen before I knew that quirky fact. So please welcome Tony Waters, the Principal and Portfolio Manager of QVG Capital. Thank you, Tony. Oh, shit. Sorry. I clicked it on there. But sorry, mate.
Sure, it was all good. I think I was meant to say nothing illegal, but hang on. Here we go. All right, GTN. GTN stands for Global Travel Network. Very simple business. As the name suggests, they stick a helicopter up in the sky, or these days linked in with someone in the road traffic network through the RTA, and send out a traffic report through the radio. So, simple business. What's so exciting about that? Not much, really. Until next time you listen, you go home tonight, have a listen to the live traffic report, and pay special attention to the end of it, because you'll hear a 10-second live read from an advertiser. And that's great. That earns them a bit of income for that slot, but it's only $138 per slot. That's not so exciting until, and this is where the magic starts, that they do that for every major radio network in the country, including Australia's #1 network, Austereo, where they have an agreement for over a decade. So the beauty of that is that they reach, in 1 week, over 10 million people in Australia. Now, the irony of the media sector now is that in a digital age where you're getting increasing fragmentation in the market, there's a premium for an audience of that size. Even a AFL Grand Final, you'd be lucky on the 7 network to get more than 6 million viewers for the Grand Final. So to be able to reach 10 million audience in 1 week is fantastic. And as we all know, if you look at that slide and look at the picture there, we're spending more times in our cars. I know coming to the airport this morning, the traffic's not getting any better, I can assure you. I'm sure you can all attest to that. So the beauty is, and the magic in this business, is the network effect. And the suppliers of that network, being the radio stations, love it as well, because even if you're Austereo and the largest network in the country, you're not even getting a quarter of that audience. So effectively what GTN do is give the radio networks the power of a national audience with an audience that's unprecedented from a concentration and an audience point of view in the traditional media sector. What does that mean? That means just for Australia alone, after they pay the radio networks for those slots, after they pay their salespeople, you end up with 40 million pre-tax per annum just for Australia. Now, it's not just Australia. You've got Canada, you've got UK, and you've got Brazil. Now, Canada's very interesting because just recently they signed up the Rogers network, or the balance of the Rogers network, which included Toronto, where there's an old guy flying over in a plane who's now retired, and now GTN has taken over those slots. What that means is that the slots that they provide to Canada is very similar to Australia. In fact, Canada is probably the most replicable to Australia of any country on earth. Similar population, similar demographics, similar media industry, but they're paying only half, the advertisers are paying only the half amount per slot that what they have in Australia. And the reason being is, if you don't have Toronto in Canada, it's a bit like, I'm in Melbourne, so I'll say Melbourne. It's not like having Melbourne in your #1 network in Australia. So it's not quite the national audience that you covered. So now they have that in Canada. We expect to see that rate to go somewhere close to Australia. In fact, almost certainly it will go up immediately once they get Rogers Toronto on board. And the beauty of that is that incremental revenue dollars is almost 100% margin for that benefit. One thing GTN do, and the value of having a national audience share that they have, is that it's a great call to arms for an advertiser. So if you listen to the ads, you'll typically, what's the Woolies special for the next week? Go out and get your ticket for Powerball because it's jackpotting tonight. Go out and buy the new RAV4. It's that call to arms sort of approach, and you can't replicate that really on any digital forum anywhere near the scale, because digital forum is very targeted, very niche in its approach. 40 million pre-tax, I mean, the whole company only makes a little bit more than that. So for UK, Canada and Brazil, you're not getting much at all. The incremental margins in Canada means hopefully one day that you'll see a market that could replicate Australia. So effectively, you're going to get a doubling in your earnings. And then, of course, you've got Brazil. Brazil was loss-making. It's now profitable. Vast market, quite fragmented radio network, and very urbanised population. And I've been there, I know what the infrastructure is like. You've got traffic jams beyond the scale of what you have in Australia. So a lot of people sitting in their cars listening to radio, and they're getting good penetration rates there as well. So effectively, while Australia's mature, It's very little in terms of capital required to maintain that earnings base. So effectively, you're getting that in cash flow. Now that Canada's profitable, now that Brazil's profitable, there's now not a lot of need for that cash flow other than giving it back to us as shareholders in the form of dividends. So we think over the next couple of years, this company will pay on today's price high single-digit rates in franked income coming out of Australia, and still getting good growth on that dividend income stream also. So for that benefit, I'm getting a market multiple for this stock well under what I'm paying an average market multiple for a small cap stock in the market, and that's pretty much just for the Australian earnings without the upside benefit that we're getting from Canada and Brazil to come. So simple story. When you listen to your radio, if you're a GTN shareholder, you can deal with the traffic because you know you're making money at least when you hear that 10-second ad at the end of the report. So thanks very much.
Thanks, Tony. Great. Thanks, Tony. And I must admit, I do listen to those reports every day when I'm getting ready for work, and I also walk to work, so I'm actually quite glad that I don't have to get out there in the traffic. So thank you. So now we're going to have our panel session, which is James Thompson from the AFR, and he will be interviewing Peter Cooper from Cooper Investors and Jack Lowenstein from Morphic Asset Management and Jeff Wilson from Wilson Asset Management. Now, just as far as James goes, I mean, his columns are absolutely a must-read in the AFR, particularly at the moment with his coverage of the Royal Commission. I don't know about you, but that's the first column that I read in any media outlet about what's going on in the Commission. Now, as far as James's quirky facts go, it's quality, not quantity, because he tells me that he still really struggles to spell the word definitely. So that's a quirky one for a journalist. So thank you, James, and wonderful to have you here. Peter Cooper from Cooper Investors. I mean, Peter is a devotee of yoga, proper breathing and meditation, and he, mind health is really the key for Peter. Cooper Investors run 5 funds, and one of them is named the Brunswick Fund, and that's because that's where Peter grew up. So great to have you here with us, Peter. Jack Lowenstein from Morphic Asset Management, one of our FGG fund managers. Now, if you haven't seen Jack's abs actually at Bondi Beach where he plays volleyball, you just need to visit the Sydney Botanic Gardens. Jack spends most of his lunch breaks at the gardens practicing headstands. So there you go. And if it's raining, you'll find him at the movies watching his favourite film, Zorba the Greek. And finally, Jeff Wilson. Well, there's a number of quirky facts about Jeff, but one I can disclose today is that he failed English in his final year at school. Then he wanted to be a vet, which explains why he's always wanted a parrot in the office at WAM. So over to you, and thanks, James.
Thank you, Louise. And congratulations to you and Jeff on the Future Generations event and the fund. Very lucky to have a great panel with us, so we'll jump straight into it. The markets have looked very, very tricky in the last little while, but I'm sure seasoned professionals like you wouldn't have been panicking. Jack, we might start with you here, because I know you were in Canberra telling everybody that you were quietly confident about the global markets a couple of weeks ago, and you were worried you looked a bit silly, but this morning, Wall Street's soaring, you look like an absolute genius.
For a day. Our view is that we think that markets have got a lot of reasons why markets will still go up, but it won't be the same stocks that have done well for the last 5 or 6 years. We expect a big rotation from highly priced growth stocks to value stocks, and we're also expecting quite a big rotation from developed markets like the US and in Europe to emerging markets, and that's mainly a valuation issue, but also because there's quite a lot of good drivers for emerging markets that are inherent in those countries. So that's why we're bullish. We're not super bullish. We're obviously not going to get 20% plus returns, I think, over the next 5 years, but we do still think that if you select the right sectors and the right stocks, you'll get pretty good returns.
Peter, are you seeing this as a Are you ready to move into buying mode yet, or how are you seeing the rush?
James, in your opening remarks, I'm reminded of that saying, if you can keep your head while all others are losing theirs, maybe you just don't understand how bad things are. So with that caveat, we think the latest downturn and so forth is very, very healthy. Definitely some excessive pricing in the market, particularly in some of the sectors that were mentioned before. And so I think there's some healthy signs in the correction. A number of sectors in Australia and overseas, if we use the banking sector here, really a lot of normalisation around return on equity. They were up at 20 times ROEs. They're down in the sort of 12 to 15% ROEs for some of the major banks. As an indication, might be a little bit more pain to go there, but there's been a lot of derating and rebasing. I think we've had a very long cycle of what I'd call financialisation or securitisation of everything: property, stock markets, LICs, ETFs, and I could go on. And that's been a 30-year occurrence, and I think there's, we're definitely in a sort of a long cycle of normalisation. So in that spirit, we would think, in terms of 5 to 10% returns for global equities, with some opportunities which we'll come back to.
Mm-hmm. Jeff, you've been talking about the end of the bull market for some time and the need to be flexible around cash. Are you still feeling like that even after a bit of improvement in the last few days?
Yeah, I mean, one thing, and I suppose from my perspective, just looking at the big picture, is now we've had that, as a 20 or 30 year bull market in bonds. We've had the last decade, enormous amount of liquidity pushed into the system, asset prices moving to high levels. We've had with QE, and now in the US, sort of in the start of October, we've got QT, so quantitative tightening, and we've also got interest rates backing up, and the Fed, unfortunately, the Fed has never got, they've never tightened correctly. We always tend to have a recession, and I don't think the US is in great shape in terms of their balance sheet. So I'm very nervous about that. And one thing we do know is, we have bull markets and we have bear markets, and we know that what follows a bull market is a bear market. And we've had the longest bull market ever in terms of duration in the US. I think we've had the top. One of the positive things is, even though the bear markets are incredibly painful, they are very swift. And of course, this time it's always different. And however it unfolded last, during the GFC, it won't unfold this time. So I'm not sure how, but we're just nervous, and we'd probably like to plan for the worst and hope for the best.
Yeah, that's a good adage in life, probably. Now, we've heard some great tips from our fund managers today, but before we get to your tips, I'm just hoping you could share with us a disappointment from the year, something that didn't quite work out the way you'd hoped, or alternatively, something that you think's worth shorting. Is there one, Peter, that didn't quite go right this year?
I thought you might ask this question, James. So I was actually thinking about our portfolio disappointment. There are a number, but there was a bit of a sign on walking into the auditorium today. And there's a room next door here called Eureka, and it really sent shivers up my spine because it's been an absolute disaster for us. A little company in the low affordable rental business, and but we're sticking with it. It sort of bottomed out at 20 cents, and we've got it back to 30 cents now, and we haven't quite got our money back, but it should be a very stable, growing business, but due to very poor management and board, it wasn't that.
Well, hopefully things improve. Jack, anything from you?
Yeah, I guess my biggest disappointment this year is a stock that we've actually just purchased about 3 months ago. It's one of the stocks I picked on the Canberra Roadshow. It was a company called China Everbright, which is a waste-to-energy company in China, as you might have guessed. The business itself is growing at 15-20% a year, and it's a wonderful business. Basically, they take municipal waste from local authorities who've got no place to dump it anymore, and they burn it, and they get paid for the electricity they generate. And the reason why it was disappointing for us is that nothing went wrong in the business at all. And we bought the stock at about 10, it went to about 13, I think, if I remember rightly, and then it fell to about 9, which for us is very bad because we operate with what are called stop losses. So if a stock falls that far, we have to cut. And we cut, and we're thinking, what the hell went wrong? How did we lose money here from that high watermark? And then about 2 months later, they announced a massive rights issue. And we thought, aha, word had leaked. And so we bought back in at the rights issue price. So we're pretty happy about it. But it was, I guess the lesson I took away, and always the things, we're constantly learning. What I learned here, and what I learned here was when you've got a government-controlled company in China, there's always the risk they'll do something that the government wants them to do that is not aligned with what shareholders want to do. And in this case, the government said they wanted this waste-to-energy business to grow much faster than they could afford to do with their own balance sheet, so they had to do the rights issue. The good news, they won't do another one for 5 years, so we're very, very happy about the stock.
Okay, well, two that'll look good. Now, Jeff, I know nothing ever goes wrong in the Wilson family of investment company.
We just don't have enough time.
But just
I know the clock's on.
Just give us one little one.
Well, no, but in terms of from a investment perspective, I remember we read an article in the Australian Financial Review, of course,
yes,
a number of years ago, and it talked about this US fund manager, how it outperformed the market by, I think, 3% per annum.
Bernie Madoff?
Over a long period of time, and how I think he worked out that he got something like 45% of his calls wrong. And around that time, we looked at our calls, and we were a bit fortunate. We'd actually done a little bit better than that, but we actually got 60% of our calls wrong.
Right.
And to me, it's all about when you make the mistake, to accept you've made a mistake and then sell. But to me, in the last 12 months, I know when we've been talking about what we'll discuss here today, it was sort of what's been your biggest disappointment, and I actually think it's moving office. And the reason I say that is because we decided to move office. We were sort of barging. We sort of had 30 odd people in a very small area, and my view was we could fit double the amount of people there.
Right.
But that wasn't everyone else's view. And then when we decided to move office, and by the time we finally found something in the early part of the year, we ended up moving to an office where it was a lot more expensive. I think not per square metre, but we're taking a lot more square meterage. And this is around March, April, when I said, okay, the date we'll move is October. And I knew that is going to be the top of the market. And that's why, because we've tripled our rent cost. And to me, that was the sign. So that's the big mistake we made this year.
If I might say, what Jeff's really saying is he misses me, because I was on the 3rd floor, he was on the 10th floor. He just misses me in the lift well.
Well, every dollar's being looked after at the Wilson family. Now, we should get on to the other side of the coin. Peter, kick us off with a stock you're excited about to watch in the next 12 months.
Well, we really love backing successful people and people with track records that we can follow. And I've come across this company called Liberty SiriusXM, and it's a tracking stock that trades around 32% below the underlying business, which is a company called SiriusXM. So it tracks the fortunes of that company. The fellow behind it is, behind the tracking stock, is a guy called John Malone. And John Malone, some of you may remember, was behind Austar, a regional pay TV company here in Australia, and really turned that round. It was almost bankrupt at one stage, and but got that ultimately taken over by Foxtel. And but he's mainly operated in America and Europe in the pay TV area and the new media area. So he's got a fabulous approach to value investing, and he's not just an investor, but he's an operator as well in terms of providing management expertise. Now, SiriusXM, won't spend too much on it because it's not familiar to Australians. In America, it's effectively a pay TV, but with radio beamed into 34 million cars in America. It's a beautiful business, $15 a month subscription fee, and it's high quality, curated, exclusive content, both music, sports rights.
Traffic reports?
Traffic reports. And there's a number of compares. Howard Stern's a very, very famous one. So people love this in the 1 to 2 hours of commute time you spend in some of these big American cities. And they've just taken over Pandora, which has been closed down in Australia, but they've got 78 million Americans. It's a free to air model. It's the biggest internet platform in America. It's the third most downloaded app in America behind Facebook and Google. And now they've got combined over 100 million subscribers. So we're very excited about the opportunity to monetise, particularly that Pandora takeover.
Are there any quirks to a tracking stock that it's not something we're familiar with down here? Is there
Look, there's some. You should think of it as a non-voting share. So there's, you have less property rights as such than owning ordinary equity. These things typically trade between 5 and 15% discount. This one's trading at 32% discount. People are concerned that without those property rights that John Malone will run off and do something crazy, with the capital that's in there. There's no evidence in the previous 4 that we've been associated with that will happen. The one thing, however, for that discount to close up, and ultimately, quote unquote, he says these are temporary instruments, and so ultimately this will get wrapped up into the head company or sold, and you'll get that realisation. But the key point is that we like the underlying business. So you're going to get a good investment at 6% free cash flow yield, duopolistic, monopolistic business, plus you get that cream on the cake of the 32%.
Malone's one of the guys who's really given Rupert Murdoch a bit of a hard time.
He extracted maximum value out of Rupert, and that's not easy to do.
Absolutely. Jack, what's got you excited for the next 12 months?
Okay, well, I think I'm going to talk about Axos, which is a new old name. So, interesting enough, so we came 4th in Bank of Internet, but in fact, at the peak, I think we were winning. Bank of Internet is a branchless bank in the US, and I talked about it last year in Melbourne. I'm not going to go. I think on my slide was a picture of Warwick Capper in very tight shorts. I said the shorts were too tight. Some of you may remember. Well, they were. The shorts have been squeezed out gradually. The stock has come down from about $45 at its peak to $31, so we still made money despite that fall. That's still within our realm of we've made so much money on the way up, but still within our realm of acceptable returns. It's now started to rally again. It's on about 9 times next year's earnings. And a quirk that people have not really picked up on, Bank of Internet does the banking for America's largest tax return filer, H&R Block, which is obviously operates in Australia as well. And a thing that I've picked up on, which has not yet been talked about a great deal, I think, is that next year is going to be a record year for tax refunds in the US, because American taxpayers have still had their pay-as-you-go taxpayers had their tax withheld at the old rates, but they're going to get a refund based on the new lower rates. So the returns next year are going to be huge, which is really important for Bank of Internet, because for various parts of the year, about 15% of its total loan book is tax refund loans, which aren't really loans, to US taxpayers. I think this year will be nearer 20%, because there'll be more money coming back, and therefore they'll be able to approve larger refund prepayments. There'll be less bad debts, because there's always a few bad debts, because they're going to get so much more. And I think the other thing that I really like about it is that they don't really lend the money. They give the people who get refunds a prepaid card with either $700 or $1,500 or $3,000 on the prepaid card. So effectively, they're giving them money. It's a deposit in their own bank. So and people don't pay them. People don't use the cards. Amazingly, they often have not fully used the cards before they get the refund. So it's a beautiful business, because it's a zero-cost deposit as well as a loan on which they get a margin. So I think it's going to be an exceptional year for them.
So what happens if you lose the card? You lose the money? Is it like when we were younger, when you buy the beer tickets?
A bit like that.
If you go home, wake up the next morning, all these tickets I've got.
Yeah, that's called seniorage, and they do get that. It's amazing, but it's true.
What's it called?
It's like seniorage. Well, it's like when you issue banknotes.
Seniorage?
Yeah, if you issue banknotes, it's that seniorage. Yeah. So they're effectively issuing banknotes. It's a beautiful business. It's very well run. The shorts are going slowly, but there's still enough there. If there's a good run of results, they're going to get squeezed further.
One for this year? I know that's...
This is last year's and this year.
I'm doubling down.
By Starbucks.
You're Starbucksing.
Yeah, I'm Starbucksing.
Great.
But for this year, if I can go for the second one, just very quickly, China Water. We are very cautious about China in general. We think there's a lot of crooks operating that market, I'm afraid to say. A lot of the stocks are very dodgy. But but China Water, and also a lot of the themes I think are very unsustainable, but the one thing that we're really bullish about is where you've got the alignment of what the government wants and what the people want. And so environmentally focused stocks in China are very exciting to us because the government knows, rule number one for the Chinese Communist Party is stay in power. And these days, it's not enough just to get richer, you've got to make people's lives better. And the environment is really terrible. For those of you, I don't know how many people in this room have been to China, but it is really shocking. And water is one of the biggest problems. So China is both the world's most water-scarce country and one of the most wasteful with water. And one of the reasons for that is that typically people don't pay for the water they get out of their pipes. So what China Water does is it goes to local authorities, typically in second and third tier cities, and says, "Can we do it? Have we got a deal for you?" And the deal is that they will take over the water supply, and they'll leave the local authority with 40% ownership, and they'll take 60% ownership. And typically, when they go, those local authorities are losing money because they're not getting paid for the water they deliver. So China Water comes in and it ends a leakage, and by leakage they mean non-payment. So they'll put proper meters in, they'll improve the pipes a bit, and so the local authorities who are very cash-strapped in China go from having a losing proposition to a dividend stream from a 40% owned company. And meanwhile, the environment's being improved because you're saving a lot of water, because people use it more rationally. So that's my number 2 pick. And by the way, that stock's on about 9 times PE. It's probably going to grow at least 15% a year for the next, I would say, for 10 years. And we love emerging markets. We're very bullish on emerging markets at the moment.
I love the little joke, the leakage.
Yes, indeed. I could have gone further.
I noticed everyone was laughing at that.
I know. They're all wide awake. It's a cash drain.
So they're paying attention, but
I know.
And maybe it's the accent.
855 HK. I love when a Kiwi calls a real. Jeff, for those of you who don't know, quirky fact about Jeff: born in New Zealand.
Yeah. Hey, at least I worked out when to get out.
True.
I left at the age of 3 months.
I was made in India, but born in Perth. What can I say?
Oh, mate, sorry. All stocks.
Jeff, can you let everyone know so we can short your pick?
Yeah.
Just kidding. No, sorry. I mean,
short my pick. Well, actually, hey, now because we're doubling up now. I like how Matthew won twice. I'm the top 5. I want 2 stocks too now, Jax. Poor old Pete. We didn't tell him to pick 2.
He's very confident in Sirius.
Exactly. So now I want 2. And in terms of my, as you know, I love buying $1 for 80 cents. And I've got one of those stocks. And I'll tell you the code first, because if I say the name, everyone will choke. The code is BAF, and I'll declare our interest. That's the Blue Sky, their LIC, which we have put a proposal up to manage it. It's alternative access, $1.10 of NTA, trading around 86, 87 cents. So that's you're buying $1 for 80 cents. And assuming we are successful, now, the other people withdrew this morning in terms of the ones we were against. Assuming we're successful, then I'd be disappointed if it can't reflect the true value and trade at NTA or a premium. And in terms of water, we're talking about leakage. Now, of course, they own 20% of their assets are the water rights.
Yeah.
So just with that theme. And just probably to work with that, so that's a low risk play from my perspective. And you probably want a bit of grunt there, some high risk.
Absolutely.
And as I always do, every day I start my morning with reading the Australian Financial Review. And of course, what I always do is I always start on the back page, Chanticleer, because I know that you may be writing.
That's right.
Okay. And Tony, I've got enormous respect for yourself and Tony Boyd.
Yes.
So this morning, I was reading it with great interest, and the second stock I'm going to pick, which are those that, unfortunately, I'm not in Melbourne tomorrow. I'm at the House of Reps Economic Committee.
We'll get to that.
I'm in Sydney at DY presenting for our submission on franking credits. So unfortunately, I'm going to miss the Myer AGM, but I'm sure that you should go along, because I'm sure there'll be a lot of excitement and fun. And it's Myer. To me, it's we like to buy undervalued growth companies and buy them when we see a catalyst is going to change the valuation. And our catalyst is new management. And the great thing is you've got there, You've got an expert retailer, which is paid a lot higher price than we did, and is sitting there, and as we read every day, with Solly, I've got enormous respect for Solly. He's keeping the whip out on everyone, particularly the board. And to me, you could easily, if John King is as good as we think he is, and like who knows, to me you can make 50 to 100% on your money. And I don't think Solly could throw any more at Myer over the last month or two. So, to me it's...
Well, Jeff, some news on that. Premier Investments held their AGM today, and Solly has announced he will be supporting John King's option package. So he has, I can't believe I'm saying this, he has agreed with you about John King and is prepared to back management. So maybe the weight of Solly will be in your favour as well on that one.
Let's hope.
All right, now I want to finish, we haven't got much time. Jeff mentioned the F word, franking. I think we all know his stance on there, but I just want to get Peter and Jack. What do you make of this franking credit change that Labor's proposed? I know Jeff's very passionate about it, but I'm keen to hear what some other fund managers are making of it.
Just very, very briefly, a little bit surprised. I've been looking around. I think there's no doubt, both in Australia and globally, the big tax man trend is alive and well, and so they're coming after everyone. I was a little bit surprised because we sort of tried to think about who are the sacred cows in community, and there's two standouts. One is pensioners, the other one's at the agricultural sector. Now, the worst hit as a result of, if it gets implemented as proposed, are these pension funds and pensioners. So that's a little bit surprising to me, and so we'll have to see how that plays out.
Jack?
My view is that unfortunately, this is what we're going to see with the Labor government, which I think unfortunately we're doomed to get, is they will back the industry super funds who will keep the franking credits, and they will try and attack, if I might say, the people on this panel and the people in this room, the people who have SMSF funds who will lose their franking credits. So it's really a direct attack on the independent middle class of Australia to the benefit of their union mates. So I'm disgusted, to be honest.
Good on you, Jack.
And Jeff, you mentioned you're heading to front the panel tomorrow. What are you expecting? Will you led a protest? Will you be dressing up? What's your what's your next?
Yeah. So if you're in DY tomorrow, come down, look online, or email us, and please, and bring your little placards if you've got them.
What time is it?
I'm on at 9:30. Oh, you might. I got 40 minutes. And to me, the great thing is there are Labor politicians on the House Economic Committee.
Yep.
So I want them to hear the stories to me, and I'd love them to ask me some questions, because I just think that effectively everyone will change their behaviour. We're highly intelligent. We've evolved into highly intelligent human beings.
Most of us.
So the fact that Labor believes they'll raise $5 billion is a mirage. And to me, it's just exactly the same as the mining tax. Badly thought out, badly timed. Mining tax was going to raise over $5 billion. It ended up, and even after they changed the mining tax, in the budget in 2012 was going to raise $3 billion. What did the mining tax raise? $126 million. It cost $50 million to set up, $40 million to advertise, and $20 million a year. And so, unfortunately, everyone is going to change their behaviour. And whether that's, you put children into your fund, if it's a self-managed super fund, so then you become like a little baby industry fund in terms of you can use the tax on that side. Whether you actually go into the industry fund, and I could actually you can run an SMS on the side of an industry fund. So everyone will change their behaviour, and unfortunately, the $5 billion they're going to spend on education and schools won't be there, and it'll be another example of just poor management.
Well, let's hope you get a great hearing tomorrow. And ladies and gentlemen, can you thank our fantastic panel?
Thank you very much, gentlemen. Thank you, James, Peter, Jack and Jeff. And Jeff, I'm surprised you haven't got a bus organised to take everyone up to DY from here. Probably a few takers with those placards. So thank you very much, gentlemen. Really appreciate those thoughts, and particularly to you, James. We know how busy you are with the Royal Commission. Now, our next presenter is Oscar Oberg, who's the lead portfolio manager at Wilson Asset Management, one of our FGX fund managers. And following Oscar's wedding, his wife sent their wedding photos to the Telegraph in Sydney. And without him knowing, she had a friend that actually worked at the paper. And she actually writes up the weddings of the week section. A few weeks later, Oscar woke up one Sunday morning to see a double-page spread in the wedding section of the Sunday Telegraph with the title Rocky Road Romance, surrounded by their wedding photos. So that's a cracker, quirky fact. So please welcome Oscar to the stage.
Yeah, my wife likes to stitch me up, which you'll find out in just a sec. Well, thanks, Louise. It's a great honour to present here today on behalf of Wilson Asset Management. Now, I'd like to ask the audience a question. Can you please put up your hand if you think that having a baby for the first time is the most rewarding but the most challenging thing that you've ever done in your life? Come on, put them up. Surely more. I can honestly say, as a father of two young kids, that having a baby for the first time is definitely the most rewarding thing I've ever done. But I tell you what, it's bloody tough. I mean, think of all the dirty nappies, the endless crying, the spewing, and my personal favourite, the lack of sleep. I mean, the list just goes on and on and on and on. But one of the things I think is the hardest thing about having a baby is deciding what to buy for them before they're born. I mean, do you want the standard pram? Do you want the travel pram? Do you want the jogging pram, or you want all three? Do you want the standard baby wipes, the scented baby wipes, the fragrance-free baby wipes, the 3-ply, 2-ply baby wipes, or, my personal favourite, do you want a warmer for your baby wipes? I mean, for a simple bloke like me, it's bloody confusing, and it feels a lot like this. Now, that's my wife stitching me up again. So that was literally taken a week before our first daughter, Isabella, was born, and it was obviously taken in the shop that I'm going to pitch today as a buy idea, and that is baby bunting. Now, baby bunting first listed on the ASX in November 2015 and is now the leading baby retailer in the country. It has over 50 stores and is looking to grow its store network to over 80 stores. And now, a child is born in Australia every 1 minute and 42 seconds. And for these reasons, we believe that baby retailing is the most defensive category in the retail sector. And we believe that baby bunting is well positioned to take market share in this growing $2.4 billion market. Now, we are positive on baby bunting for the following two reasons. And the first is competition. Now, over the last 12 months, baby bunting's competitors have been absolutely decimated in a tough retail environment. We've seen over 70 stores leave the market, with the highest profile casualty being the Babies R Us, which was, of course, owned by Toys R Us over in the United States. This has left baby bunting with a dominant position in the market, with baby bunting's 50 stores compared to its nearest competitor with only 3 stores. And over time, we believe that baby bunting will become the category killer in the baby retailing space, in the same way that Bunnings has become the category killer in the home improvement space. Now, with 70 stores leaving the market, this has opened up a $138 million revenue opportunity for baby bunting to take market share. Now, based on the proximity of baby bunting stores, we believe that baby bunting can take 30% of this $138 million of revenue over the next 2 years. And look, finally, on competition, we believe that baby bunting can accelerate its store network towards that long-term 80 store target much faster than what the market thinks. And that's as they take on some of the vacant leases left behind by the closed stores. And the second reason why we're positive on baby bunting is around margins. Now, pleasingly, the improvement in the competitive environment has come at the same time when baby bunting has invested into its supply chain. What this means is that the cost savings and efficiencies gained by investing into its supply chain will be reinvested into lower prices to benefit the customer, and we believe this will improve market share and also top-line growth. And also, given the improved scale of baby bunting, We believe that their private label and exclusive brand offering will increase from currently 20% of sales, and we believe this can get to 50% of sales over the next 3 years. So for these reasons, we see a lot of upside to margins. At present, Baby Bunting is only doing 6% EBITDA margins, and we believe margins can get to 10% over the near term. So in conclusion, we're very positive on Baby Bunting and see a very strong long-term outlook for this business and believe that Baby Bunting can become the Bunnings of the baby retailing sector. We think that the business can grow at over 30% per annum in terms of its earnings per share, and putting this all together based on the current share price today of around $2.20, we think it can get to $3.20 in the next 12 months. Thanks a lot.
Thanks, Oscar. Fantastic. Thanks very much, Oscar, for that one. I love the photo too. So our next presenter is Yunbei Liu, who's the portfolio manager at Tribeca, one of our FGX fund managers. And JB, as she is fondly called by near and dear ones, can talk endlessly on her passion for food, her long list of travel and misadventures, her daily awkward encounters with people whose names she can't remember, celebrity lookalikes, and well, just about any topic with enough enthusiasm and energy to challenge a long life battery. So please welcome Yunbei.
Thank you. Good afternoon. Look, I was born in China. It's hard to remember English names, so I have excuse. So today, I am here to talk to you about Costa Group. It's a fresh food company that operates in the structurally growing categories, the superfood categories. They grow things like strawberries, raspberries, blueberries, avocados, and citrus. Now, sort of category that your millennials will rather spend their dollar on rather than buying houses. The company itself has been growing at 26% per annum compounded since listing 3 years ago. And we project that to grow between 10 to 15% over the next 5 years on very conservative estimates. We believe the company would deliver you over 30% return over the next 12 to 18 months. And you will double your money in a few years' time. Now let's take a look at this company in detail. Now, Costa was first listed in 2015. Initially was producing mushrooms and tomatoes and just started to double its capacity or increase its capacity in blueberries. And 3 years on, the blueberry category has been growing more than 25% per annum for this company and making it the largest producer in blueberries in Australia and now contesting for the world's largest. It has since expanded its production to other regions around Australia and in fact gone overseas. It's now producing in Morocco as well as in China. And both areas has been very successful for the company. Now, Costa is also the largest producer in tomato and mushrooms and lead producer in citrus and avocado. Now, citrus and avocado are a very new category for the business. They only just entered into over the last few years. And now, in the next forecasting year, together, they will contribute more than 40% of the earnings. And both are projected to grow at double digit over the next 5 years. Now, as you can see, Costa's produce are very much exposed to the structurally growing categories. So the demand is very much underpinned by the consumer shift into the healthy alternative, healthy lifestyle, as well as the demand coming from Asian consumers for high quality fresh produce. Now, what's really special about Costa, aside from being the pure play into the superfood category, is its strong management team, as well as its disciplined approach when it comes to investment, very unlike a lot of other agriculture businesses. Now, the company has consistently delivered over 20% return on invested capital on a 3-year basis. And the team at Costa, led by Harry, has been with the business for close to a decade and has done an incredible job in improving and reducing the agriculture risk that is inherent in this business. So what have they done? They invest into buying better genetics, so they have bigger fruits, so they are more disease resilient. And then they invest in better growing condition, so they can ensure the consistent condition for growing a lot of those produce. They invested also in cold storage, so they can manage the yield throughout the years to ensure consistent return. And of course, they have moved to different geographical locations, so they can produce the fruits all year round. Now, Harry and the team has done an amazing job for this company. And if I show you the next chart, which is earnings, you won't be surprised then that it's very much unlike any other agriculture company, or most of the agriculture company, that's very much look like a growth company. So it's delivered 26% compounded for the last 3 years per annum, and projected to grow 10 to 15%. Now, of course, these growth projections are merely based upon what they have in today's portfolio. I can assure you that in the next 5 years, there will be more addition to that portfolio. Remember, citrus and avocados, they were not there just over 2 years ago, and now they will contribute more than 40% of the earnings in the next forecast period. So any additional growth will be on top of that. Now, share price. Global equity market volatility has seen the share price come off. And of course, there was a little bit of confusion as the company changed the year-end day, and there was a bit of confusion in terms of seasonality. Now, we see these as great buying opportunities. So to sum up, why is Costa a great buying opportunity today? It's got a great management that has consistently delivered returns. Its business operates in a structurally growing space, and that it will be underpinned by multi-decade growth out of Asian consumers, as well as a shift to the health lifestyle. And the stock at current price is offering very attractive buying opportunity. Thank you very much.
Thank you. Thanks a lot. Fantastic, Junbei. Okay, so next up we have Graham Hay, and he's the Deputy Portfolio Manager of Antipodes. Graham rides a Vespa to work. He's a part-time soccer coach in the winter months. I'm not sure what he does in the summer months, but he's a super keen golfer. He's just returned from an annual golf trip, which is now in its 15th year. So please welcome Graham. Right? Yeah, the green one, yep.
I'm not sure what that means. I was curious to know what the music was going to be, but I'm still none the wiser, actually. Thanks, everyone, and thanks for the opportunity to present to you. As Louise mentioned, I'm Graham Hay from Antipodes Partners. I'm going to talk to you today about a company that is a top 10 position for us in our funds, and a company we've been involved in for about 3.5 years. Now, in the dark recesses of your mind, you'll no doubt have the company Cisco Systems lying dormant there. It was, in its day, one of the 4 horsemen of the internet. Briefly, in 2000, was the world's most valuable company with a market capitalization of $700 billion, only to see that all but eviscerated in the 2 years that followed, as the wave of interest receded and the business reset to much lower levels. And in many ways, in market cap terms, today, Cisco Systems is a shadow of its former glory. But as a business, we believe it's as strong as ever and is facing some very interesting growth trajectories under a new management team. So let me talk you through 3 key points as to why we think this is an interesting story and why it's, in fact, a large position for us in our funds. The first one is new management. What we've seen through Silicon Valley over the last 4 or 5 years is a sea change in management teams amongst large incumbent technology companies. And we saw that with Microsoft in 2013. And about 2.5 years ago, we saw the same thing with Cisco. And we think that sort of generational change in management is oftentimes a catalyst to unleash some of the bound-up virtues of a company. We saw that very clearly with Microsoft, where the new CEO came in and really liberalized the company and opened up their technology to new opportunities. And we see the same thing today happening at Cisco. Cisco is a company that have traditionally effectively sold boxes, which have contained very high-tech equipment that allows data to be routed around the world. That method of selling boxes was very effective for the first 25 years of their history, but customers have evolved. And what it's required of Cisco is for them to evolve as well. So under a new CEO, the company have begun to liberalise their technology stack. That is to say, they have evolved the way that they sell their products to market and are much more accommodating to the needs of customers. And those customers today are companies like Amazon, they're companies like Microsoft, they're companies like Alibaba. They have very different demands than the traditional Cisco customer, which is a corporate IT department. It's taken a while for Cisco to adapt to this new method, but the early signs are very good, and we're seeing traction with some of those new categories that have evolved into the market in the last few years. So we've got a company with great technology that's evolving. The second key point that we'd like to emphasise is the changing spending landscape. It might seem strange, but corporate IT departments for most of the last 15 years have been sweating their assets pretty hard. The mantra has been about how can I get away with spending less for the same output, or indeed how can I spend less and get more output. In the last 3 years, there's been a change in mindset amongst corporations, and it's really been driven by fears around digital disruption. Every CEO and board of directors around the world today is on notice that digital disruption is real. We've all seen the havoc that Amazon have wreaked in the retail industry. We've seen what's happened with the taxi industry with the rise of Uber. We've seen what's happened to the lodging industry with the rise of Airbnb. No CEO or board of directors can afford to sit still now and not respond to the real threat of digital disruption. And essentially what that means is that there is a wholesale modernisation program going on regarding corporate IT departments. Companies are preparing and getting ready to meet the digital challenge, and that requires a wave of new investment across your IT stack. Cisco have a portfolio that is quite broad, but largely speaking is pointed very much in the sights of that spending wave that we see. It's everything from security through to networking, through to software and applications that are all tied together increasingly as a solution set that Cisco bring to market. So the spending environment is changing, and Cisco are very much in the sweet spot. The third reason we think Cisco is interesting is the change in Cisco's business model itself. I mentioned before that Cisco historically have sold boxes to IT departments. That meant that you would sell a box to customer A. In 3 or 4 or 5 years' time, you would go back to them and hopefully get them to upgrade to the next box. What the company are increasingly doing is that every box that goes out the door today has a subscription attached to it. And effectively what that allows the customer to do is take the box and receive ongoing technology refreshes and updates from Cisco. And for that right, they pay the company a subscription, typically 3 years. In effect, what that's doing is it's raising the lifetime value of the customer and increasing the profitability of Cisco overall. That process has just begun. They launched their first category of products with subscriptions attached a little less than a year ago, and over the next 2 or 3 years, we're going to see that program rolled out across their portfolio of equipment. So the benefit of that for Cisco is quite transformational in that it increases the value or the percentage of software that's been sold. It carries much higher margins and gives them much better visibility into their business going forward. So we've got a new management team, we've got a changed spending environment, and we've got an evolving business model. But because of Cisco's history as a legacy technology vendor, the market still perceives it as being at risk of disruption. And part of a broad theme we've got into our portfolios is incumbent technology companies, where the market can start to see the virtues of incumbency rather than the potential costs that come with it. Cisco have a worldwide installed customer base of about 800,000 people, or clients, I should say, and with that, have the ability to go back to that vast installed base, which has been built over 30 years, with innovation at a later date. We think that's an asset. The market has imputed that as a risk, and this is a situation where we think the bear case is in fact the bull case. As a result of that, Cisco trades on a very low multiple, particularly relative to an expensive peer group of technology, large cap technology companies. At current prices, you can buy Cisco shares for just 11 times free cash flow. So if you net off the investments and cash on the balance sheet and take an estimate of free cash flow over the next 2 years, you're paying a multiple of about 11 times. That equates to about a 14 times PE today, when many technology companies are trading well north of 20 times. So Cisco is a very interesting story. It's not one that gets talked about very often, but we think the horseman may rise again, and it would be our top pick today. Thank you very much.
Thank you very much, Graham. And last but by no means least, we have David Moberly, who is a portfolio manager at Paradise. And Paradise are a fund manager like Cooper Investors in both FGX and FGG. David loves the gym, and for fear of missing out on anything, he's been known to turn up at meetings with brokers and the like in his sweaty gym gear when he's run out of time. So, David, you haven't quite got the sweaty gym gear on today, but welcome and thank you.
I managed to find a suit this morning, and I actually bought this tie at the airport this morning as well, so I've done well. So thanks for your time, and I know I'm last on the grid today, so I'll try to keep it pretty punchy. So the stock we're going to talk about today is Reliance. So just in terms of a quick background, for those that don't know much about the company, it's a global plumbing supplies business. The company was floated or IPO'd into the market a few years back, and it was a partial sell down of a privately owned family business. So it gets the first tick in that it wasn't private equity and it wasn't a recycled asset. So looking at their products and end markets, they've got products all over the world, but one of the big ones is the shark bite fitting that you can see up on the slide in front of you. It's predominantly used in the repair and remodel market in the US. The repair and remodel market, it's been growing about 5% for some time in the US, but the country has actually been underbuilding since the GFC. There's an ageing housing stock, and older housing equals more repairs. So it's a relatively defensive industry, and it's one that's attractive to us. Now, in terms of the product, when a plumber comes to your house to repair a leak or some damage, they normally replace the defective plumbing. Now, the shark bite fitting, again, the one that you can see on the slide, can be used to reconnect any plastic or copper pipes without the need for any sort of time-consuming solder or expensive crimping tools. So it's quicker and it's easier, but most importantly, I think it cuts the time down of the job significantly. And more jobs for the plumber equals more money. So you can see why it's been so successful. Another important point is that plumbers do not want to be called back to the job to do any repairs. It's frustrating and it's expensive, and this is where Reliance has built an incredibly strong brand in the market for quality. And in fact, the brand is so strong, SharkBite was actually called out on a recent earnings call by Lowe's for supporting their destination brand strategy and helping them target the pro consumer. So for a company the size of Lowe's to be calling out one the size of Reliance is incredible. And by the way, they also called out that the product's been comping double digits at the moment, so it's clearly doing well. The SharkBite fittings have been growing at about double-digit growth rates for over 10 years, but despite this, still remain heavily underpenetrated at less than 10% share of the category. So in summary, we think it's a great market and the product has a long runway of growth. In terms of cash flow and returns, I think it's important for us in particular to look at what cash this business can generate for us. And an easy example that we like to use, because the numbers are simple, is 4 million of CapEx, gets you 4 million fittings, which they sell for about $4. So when you put a margin on that, it gets you a payback of less than 1 year. And these sorts of returns are unheard of in the building materials space, and I think that shows you the strength of the product, but also how low cost the manufacturing process is. So now onto the share price. The stock's been heavily sold off recently on the back of a few things. Firstly, the stock left the Small Ordinaries Index and joined the top 100. It meant a lot of specialist small cap managers were forced sellers, and generally we think it's a good idea to be buying off forced sellers because they're not price sensitive. Secondly, there's been some concerns over the US market with some soft data recently around new housing, and no doubt if the US goes into recession it will be an issue, but last time I checked, fixing some broken pipes or plumbing in your house was not that discretionary and it's not that cyclical. Thirdly, some have been questioning the organic growth rates around the business, given they'll need to be cycling the infill into Lowe's as a new customer last year. But as we discussed earlier, Lowe's has just confirmed that the product continues to comp double digit. So after this sell-off, the stock's trading at about 20 times forward earnings, which is similar to what the market is paying for boring defensive stocks, and in our view, very cheap for the quality of the business and the growth outlook. So in summary, we think it's a great business with a strong market position, long runway of growth. We like the management team. The incentives are well aligned. It's got a great balance sheet, generates lots of cash, and the current sell-off has created an opportunity to buy into the business at a great valuation.
Thanks, Dave. Well done. I must say I like the tie too, so well done. Okay, well that's a wrap. So I just want to thank everyone for being with us this afternoon. We will be sending you an evaluation survey on the back of today. So please be honest and brutal about what you think. What would you like to see that would be improved? Just by way of hands, who would come back if we did it again next November? Would you recommend it to a friend? Because we definitely want to see the friends here again next November. So thank you. I would like to thank once again all of our presenting fund managers. It's a big effort for them to do the prep, be here today. So please join with me in thanking our fund managers. And also Vicky Condon from Raise and James Thompson from the AFR, and also the team at WAM and Synergy Events who've helped us. This is actually a wrap for the roadshow. We've been on the road for a couple of weeks now in various cities. And also we've done 2 capital raisings, one for each of FGX and FGG. So it's time for a bit of a lie down, I must say. So thank you, everyone, and enjoy the rest of your day.